Hi, my name is Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. So this week, I'm jumping right back in to check on the elephant in the room this spring, tariffs. So the first number to know is 17.8%. That's the new average effective tariff rate on US imports, which is down sharply from 27% last month, but it's still the highest since 1934, and still about 5 times the level prevailing at the start of this year. It's according to estimates by the Yale Budget Lab as of the week of May 12th. This is still a very high level of tariffs, but it is really moving in the right direction of much lower tariffs. This smaller tariff hike is still expected to reduce real GDP in the United States. The Yale Budget Lab's model predicts a decline in real GDP of 0.36 percentage points in the long run after a deeper short run negative shock. But like the tariffs themselves, that impact has shrunk by almost half from what was projected under the much harsher tariffs just around this time last month. Now, just as important as the reduction in proposed tariffs so far is the sense that investors are getting that this means more walkbacks are on their way. The stock market in particular has now fully regained all its losses this year, and in fact is now up slightly year to date and up a whopping 20% from its early April trough. That suggests to me that investors have concluded we won't actually see a major hit to the growth of US companies' profits and US economic output after all this year. Some more good news is that the tariffs that have gone into effect are still not really passing through much of a price shock to consumers here. April inflation data came in about as expected without a spike in goods prices yet. So year over year inflation ticked down again, now down to just 2.3%. That's more good news. And it also means the Fed especially has a bit more room to get ready to maybe engage in some interest rate cuts later this year. Now, turning to the national housing market, we reached a major milestone of seeing more active listings at the end of April than in the same month in 2020. You can see those two lines crossing on the chart there. That's the first time that we've really seen this since the inventory plunge began that spring of 2020 with the onset of the pandemic. In fact, many parts of the country now have inventory even higher than their 2019 levels. Active listings ended the month of April 31% higher than the same time last year. So really compared to our recent history, this is a lot more inventory out there on the market for buyers to choose from. It also means more competition for the folks who are listing their homes for sale right now than they've faced really any time since the pandemic began. Now, this was a little surprising to me that pending sales actually ticked up slightly year over year in April by 2.2%. That was surprising given the negative turn in consumer sentiment last month that I discussed in last month's video. And it's important to recognize this masks a lot of regional variation. So the same data source, this was from Realtor.com's data, for instance, showed a 12.7% decline year over year in pending sales in the Seattle metro area this April. So finally, I'll check in on the usual elephant in the room, mortgage rates, which are still stuck in a range between 6.75% and 7%. It seems like the bond market just can't catch a break this year because even after the stock market recovered from the tariff turmoil, over for the bond market, it looks like the falling fear of a recession and rising expectations for an explosion in the deficit based on congressional budget drafts now circulating are all conspiring to keep bond yields and therefore mortgage rates high for the foreseeable future. All right, that is all for this week, and thanks as always for watching.